Disclaimer.
This is a red alert, and no, this is not another price spike, not a technical breakout, not a speculative frenzy driven by traders chasing momentum. What's happening right now is far more serious than that, because the signal didn't come from the charts, it didn't come from social media, it didn't come from commentators, it came from behavior. And markets do not change direction when prices move. They change direction when behavior shifts quietly, behind the scenes, long before the public notices. Right now, silver is being treated differently by the people who actually need it to function. Not discussed, not advertised, not hyped, handled, secured, allocated. That is the first and most important signal. When a market is healthy, participants argue about price. When a market is stressed, participants argue about access. When a market is breaking, participants stop arguing entirely and start locking supply. That is the phase we are entering. This is not theory. This is not prediction. This is how every constrained system behaves at the start of a structural shift. And today, that shift is visible in one place above all others: Silicon Valley. Silicon Valley does not operate like Wall Street. It does not react to headlines. It does not wait for confirmation. It plans for failure scenarios. And when it plans for failure scenarios, it doesn't announce them. It changes procurement behavior. That's what makes this moment dangerous for anyone still focused on the screen price. Because when the most advanced technology ecosystem on Earth starts behaving as if a material might not be available on demand, the market is no longer operating under normal assumptions. Silver has crossed that threshold, quietly. The reason this matters is simple. Silver sits underneath the systems that modern power depends on: artificial intelligence, energy infrastructure, advanced electronics, high-efficiency data centers, defense-adjacent technologies. These systems do not tolerate interruption. They cannot wait for the market to stabilize. They cannot redesign overnight. They cannot pause growth because supply chains failed. So when risk appears, even faintly, the response is not negotiation, it is preemption. And preemption leaves fingerprints, longer contracts, inventory accumulation, reduced spot exposure, priority access agreements, a shift from lowest cost to guaranteed delivery. These are not visible on a chart. They are visible only in behavior. That's why this moment feels invisible to most people, and obvious to the people who matter. Because once behavior changes, the outcome is no longer a question of if, only when. This is the opening phase of a supply-driven conflict. Not loud, not chaotic, not emotional, strategic. And history is very clear about what happens next. Before we go any further, we need to strip away the most dangerous misunderstandings surrounding this moment. This is not an investment story. It doesn't begin with returns. It doesn't end with price targets. And it has very little to do with speculation. Because when people frame this purely as silver going up, they completely miss what's actually happening. This is an industrial survival story. Markets behave very differently when demand is driven by survival instead of profit. Speculative demand is emotional. It enters late, it leaves fast, it responds to headlines. Survival demand is the opposite. It enters early, it stays silent, it doesn't care about price volatility. It only cares about continuity. And Silicon Valley is operating entirely inside that second framework. For decades, technology companies treated raw materials as background noise, something procurement teams could always source, something finance departments could always hedge, something supply chains would always deliver. That assumption no longer holds. The last few years shattered the idea that materials are always available on demand. They shattered the idea that markets always clear smoothly. They shattered the belief that money guarantees access. What replaced those assumptions was something far colder and more rational. If we can't get this input, we don't function. That is not an investment thesis. That is an existential constraint. Silver is not being pulled into this conversation because it's shiny or historically monetary. It's being pulled in because it performs functions that modern systems cannot replicate easily or quickly. When demand is framed this way, price becomes secondary. If a data center goes offline, the loss isn't measured in percentage points. It's measured in billions. If production halts, the damage compounds daily. So the question shifts. Not, is this expensive? But what is the cost of not having it? That single question redefines behavior. And when behavior changes, markets follow. Slowly at first, then all at once. This is why watching charts right now is misleading. Charts are built to reflect speculative flows. They are terrible at capturing structural demand shifts. By the time price starts reflecting survival demand, the underlying decisions have already been made. That's why people always say the same thing after every supply shock. How did we not see this coming? The answer is simple. They were looking at price, while the real signal was happening elsewhere, in contracts, inventory, and procurement strategy. This is the phase where the public is still debating whether something is real, while institutions have already adjusted. And once that gap opens, it doesn't close gently, it closes violently. To understand what's happening now, you have to understand how Silicon Valley actually thinks. Not how it talks in public, not how it presents itself in earnings calls, but how it behaves when something essential appears fragile. Silicon Valley does not operate on optimism. It operates on risk minimization. Every major technology firm runs continuous internal simulations asking the same question. What breaks us? Not what slows growth, not what dents margins, what stops operations. And when the answer to that question points to a physical input, procurement becomes strategic overnight. This is where people make a critical mistake. They assume tech companies behave like traders. They don't. Traders chase price. Engineers chase continuity. When engineers identify a bottleneck, the response is not to wait for price signals. It's to eliminate exposure. That's why Silicon Valley shifted away from just-in-time logistics long before the public conversation caught up. Just-in-time only works when trade is frictionless, energy is cheap, geopolitics are stable, supply chains are predictable. None of those conditions exist anymore. What replaced them is just-in-case thinking. Just in case we lose access, just in case sanctions expand, just in case shipping halts, just in case markets freeze. This mindset doesn't produce headlines, it produces contracts, longer contracts, more inventory, less exposure to spot markets, more willingness to pay for certainty. Silver fits perfectly into this shift because it lives in a dangerous blind spot. It's assumed to be abundant, it's assumed to be liquid, it's assumed to be replaceable. None of those assumptions hold under stress. Procurement teams understand something. Finance teams often don't. You cannot hedge physical absence. If the metal isn't there, derivatives don't help. If delivery fails, price doesn't matter. If a system requires silver to function, then silver becomes non-negotiable. This is why behavior changes first. You don't hear press releases saying, "We're worried about silver." You see multi-year supply agreements, quiet stockpiling, reduced exposure to open markets, preference for guaranteed delivery over price efficiency. This is also why this phase feels invisible to outsiders, because nothing dramatic has happened yet. No shock, no collapse, no headline, just a silent reallocation of risk. But history is very consistent here. Once procurement shifts from price-driven to availability-driven, the system has crossed a line it never uncrosses. Markets can recover from speculation. They do not recover easily from pre-allocation. And silver is now being pre-allocated, not emotionally, not publicly, strategically. This is how shortages begin, long before anyone calls them shortages. The reason silver ends up at the center of this story is not ideological, it's functional. Modern technology does not run on software alone, it runs on physics. And silver sits at a very specific point in that physical stack. Silver is not just another industrial metal. It has properties that are extremely difficult to replicate at scale, the highest electrical conductivity of any metal, exceptional thermal conductivity, reliability under extreme conditions, stability in high frequency and high load environments. These characteristics make it indispensable in places where failure is not an option. Artificial intelligence infrastructure is one of those places. AI data centers are not like traditional computing facilities. They operate under enormous electrical loads. They generate extreme heat. They require constant uptime. Every efficiency gain matters. Every failure compounds. Silver is embedded throughout these systems, in connectors, power management, cooling components, and high-performance circuitry. Substitutes exist in theory. In practice, they introduce trade-offs that Silicon Valley does not accept lightly. Higher resistance, lower efficiency, greater heat generation, increased failure rates. When performance margins are thin and competition is global, those trade-offs become unacceptable. The same logic applies to the energy transition. Solar panels are not optional components of modern infrastructure anymore. They are strategic assets. Silver is used extensively in photovoltaic cells because it maximizes energy conversion efficiency. As solar deployment scales, silver demand scales with it, not linearly, but structurally. Electric vehicles follow the same pattern. EVs are not just cars. They are mobile power systems packed with electronics. Silver appears in battery management systems, inverters, charging infrastructure, onboard electronics. As vehicles become more software-defined, their reliance on reliable electrical pathways increases. This is where the problem emerges. Technology demand scales exponentially. Material supply does not. Silver production cannot suddenly double because AI adoption accelerates. It cannot triple because EV mandates expand. It cannot surge because solar targets increase. Supply is constrained by geology, mining timelines, and by product economics. Demand, on the other hand, is driven by policy, competition, and capital. That mismatch is the fault line. And when a fault line forms under a system that requires uninterrupted operation, the response is not negotiation. It is preemption. This is why silver quietly moves from commodity to strategic input. Not because anyone declared it so, but because systems that depend on it cannot tolerate uncertainty. And once a material reaches that status, markets do not function the same way. They stop being about price discovery. They become about access control. This is where the narrative usually breaks down. Because when people hear higher demand, they instinctively assume higher supply will follow. That assumption works for software. It works for manufacturing capacity. It does not work for geology. Silver is not produced the way most people imagine. Roughly 2/3 of global silver production does not come from primary silver mines. It comes as a byproduct of mining for other metals, mainly copper, lead, and zinc. That single fact changes everything. It means silver supply is not controlled by silver demand. It is controlled by the economics of entirely different industries. If copper demand slows, silver supply can fall. Even if silver demand explodes, if base metal mines shut down, silver disappears with them. No price signal can reverse that quickly. This creates a structural trap. In most markets, rising prices encourage new production. In silver, rising prices often arrive too late to matter. New mines take years of exploration, years of permitting years of capital investment, years of construction. By the time meaningful new supply appears, the demand cycle that triggered it may already be over, or more dangerously, entrenched. And there's another layer most people ignore. The easiest silver has already been mined. Ore grades have been declining for decades. That means more rock must be processed to extract the same amount of metal. More rock means higher energy, costs higher labor, costs higher environmental constraints. In other words, silver is becoming harder to extract at the same time. Demand is becoming more critical. This is not a temporary imbalance. It's a long-term structural squeeze. Now combine this with the behavior shift we discussed earlier. When Silicon Valley realizes that supply cannot respond quickly, demand cannot be delayed. Substitutes are inferior. The rational response is not to wait for markets to fix it. It's to secure what exists. That behavior doesn't show up in production numbers immediately. It shows up in availability. And availability tightens quietly before it tightens visibly. This is why shortages rarely announce themselves. They emerge as longer lead times, smaller allocations, unavailable notices, sudden prioritization of certain buyers. By the time the public notices, the constraint has already hardened. Silver is now pressing against that wall. Not because anyone panicked, but because physics, timelines, and demand curves have converged. Once a market hits that point, it doesn't need bad news to break. It only needs time. This is the part that confuses most people. And it's where bad conclusions are usually drawn. They look at the screen and say, if silver were really tight, the price would already reflect it. That assumption is wrong. Price is not a leading indicator in structurally constrained markets. It is a lagging acknowledgement. Before price moves, behavior moves. Markets are designed to absorb stress quietly for as long as possible. They stretch, they substitute, they delay. And they do that through mechanisms most people never see. The first response to rising demand is not a higher price. It's contract restructuring. Buyers shift from spot purchases to long-term agreements. They lock in supply directly with producers. They reduce exposure to open markets. This reduces visible demand without reducing real demand. At the same time, sellers become more selective. They prioritize strategic clients. They reduce discretionary inventory. They widen premiums quietly. None of this appears on a chart. So the screen looks calm while the system underneath tightens. This is why every major shortage in modern history followed the same script. Before oil prices exploded in the 1970s, long-term contracts expanded. Physical inventories were drawn down. Governments secured supply quietly. Before rare earth prices spiked, manufacturers stockpiled. China restricted exports. Supply chains fractured. Before semiconductor shortages became public, lead times extended, OEMs locked allocation, secondary markets dried up, price always moved last. And when it moved, it didn't glide, it jumped. Silver is following this exact pattern. You see it in widening spreads. You see it in delivery language. You see it in availability concerns. But because none of that looks dramatic, most people dismiss it. That dismissal is exactly why the repricing phase feels shocking when it finally arrives. There's another reason price lags. The financial system is designed to smooth volatility. Paper markets exist to provide liquidity, absorb demand, delay stress. They work well until physical constraints overwhelm them. When physical material is plentiful, paper markets dominate price discovery. When physical material tightens, paper markets become a mask. They don't reflect reality. They manage perception. That management can continue for longer than most people expect, but not indefinitely. Once delivery risk becomes unavoidable, price doesn't adjust gradually, it re-anchors. And that re-anchoring feels sudden, irrational, and extreme to anyone who is watching only the chart. This is why price is the worst place to look for early signals. The real signals always appear first in behavior. And by the time price confirms them, the window to understand calmly has already closed. This is where the tension becomes unavoidable, because the priorities of Silicon Valley and the priorities of Wall Street are fundamentally incompatible. Wall Street is built around liquidity. It wants assets that can be traded, hedged, leveraged, and exited at will. Its tools are derivatives, futures, swaps, paper exposure. These tools assume one critical thing, that the underlying asset will always be available when delivery is required. Silicon Valley operates under a completely different assumption. It assumes that systems fail. It assumes that supply chains break. It assumes that geopolitics intervene. It assumes that money does not guarantee access. So when Silicon Valley looks at silver, it doesn't see a ticker symbol, it sees a single point of failure. This creates a silent conflict. The financial system wants silver to remain abstract, liquid, continuously tradable. The technology system wants silver to be controlled, allocated, physically secured. Both systems cannot win. A paper market cannot function indefinitely if the underlying material is being quietly removed from circulation. And this is where historical patterns become clear. When industrial users begin prioritizing guaranteed delivery over price efficiency, the paper market loses influence, not overnight, not explosively, but progressively. Each long-term contract removes supply from the open market. Each stockpile reduces float. Each strategic buyer tightens availability. Over time, the paper market becomes increasingly detached from physical reality. At first, this creates small distortions, then persistent spreads, then settlement stress. Eventually, confidence erodes, not because of ideology, because of math. The financial system depends on turnover. The industrial system depends on continuity. When those needs collide, continuity always wins. Because a factory cannot operate on promises. A data center cannot run on contracts. An energy system cannot rely on theoretical supply. This is why physical constraints always overpower financial structures in the end. It's not dramatic. It's mechanical. And once that process begins, it rarely reverses. The financial system can adapt to many things: volatility, inflation, policy changes. What it struggles to adapt to is persistent scarcity. Because scarcity exposes leverage. And leverage, once exposed, becomes unstable. This is the quiet pressure building beneath the surface right now, not visible in headlines, not obvious in charts, but very real to the people who must keep systems running regardless of market conditions. That is why this conflict matters. It's not ideological, it's operational. And operational realities always assert themselves eventually. Every major economic transition leaves the same fingerprints. Not in headlines, not in speeches, not in official reassurances, but in the quiet reclassification of resources. History shows this pattern over and over again. A material starts as a commodity. Then it becomes essential. Then it becomes strategic. And finally, it becomes controlled. Oil followed this path in the 20th century. Before the 1970s, oil was treated as a tradable input. After the shocks, it became a geopolitical instrument. Uranium followed the same arc during the Cold War. Access mattered more than price. Supply was secured long before the public understood why. Rare earth elements did it in the 2000s. When China consolidated supply, the world didn't panic immediately. Manufacturers adapted quietly, and governments reacted late. In each case, the pattern was identical. Behavior changed first, markets adjusted later, the public noticed last. Silver now sits at the beginning of that same curve. Not because it's rare in absolute terms, but because it is irreplaceable where it matters. And when a resource becomes irreplaceable, it stops behaving like a normal market input. This brings us to the most important warning in this entire discussion. What breaks first is not price. What breaks first is trust. Trust that contracts will settle smoothly. Trust that delivery will occur on schedule. Trust that paper representations reflect physical reality. When that trust weakens, repricing is not a negotiation. It is a reset. Resets don't happen gradually. They happen when the system finally admits what behavior has already confirmed. This is why people are always shocked by shortages, even though the signals were visible years earlier. Because they were looking at prices while the real story was unfolding elsewhere. Silicon Valley's behavior tells us something uncomfortable. It tells us that the most powerful technology ecosystem on Earth does not fully trust the continuity of access it once took for granted. And when institutions stop trusting continuity, they stop relying on markets to solve the problem. They solve it themselves. That is the phase we are in now. Quiet, strategic, unannounced. This does not guarantee an immediate crisis. It does not guarantee a dramatic price spike tomorrow. But it does guarantee that the market structure has changed. And once structure changes, outcomes become constrained. Options narrow. Flexibility disappears. Repricing becomes more likely, not because of panic, but because of necessity. The most dangerous mistake at moments like this is to assume the future will resemble the recent past. History tells us it never does. When technology demand collides with physical limits, the system does not compromise. It restructures. Quietly at first, then all at once.
Disclaimer.